In the world of finance, stability is important. But what happens when banks begin to crumble like sandcastles in the tide? The collapse of Silicon Valley Bank and Signature Bank has sent shockwaves throughout the industry, raising questions about the health of the American banking system. And as the dust begins to settle on the ruins of these once financial behemoths, the ominous clouds of uncertainty are fast looming over the entire banking system, now more than ever. As we delve deeper into the ongoing crisis, one thing becomes clear. The banking crisis is far from over. The stakes are getting higher, and the clock is ticking. So join us as we embark on a journey through the heart of this crisis and uncover more of the dark secrets lurking beneath the surface. The findings we'll be revealing in this video will blow your mind. So buckle up. The collapse of Silicon Valley Bank and Signature Bank has left the entire American financial sector reeling, sparking a flurry of panic that is yet to subside. In the wake of the disaster, regional banks across the nation have been scrambling to pick up the pieces and restore their operations to a semblance of normalcy. The fallout from these bank collapses has been far-reaching, affecting not only financial institutions but also businesses and individuals who relied on the bank services. And as lawmakers begin a rigorous investigation into the causes of the crisis, many Americans have been left to wonder how such a catastrophic event could have occurred in the first place. With the second largest and third largest bank collapses in U.S. history on their hands, policymakers are presently under immense pressure to find solutions that will prevent a similar disaster from happening in the future. And while this investigation promises to be a long and arduous process, with experts from all corners of the industry being called upon to provide their insights and expertise, it remains to be seen what the outcome of this inquiry will be. But one thing is certain: the financial landscape of America will never be the same again. It's been a tumultuous year since the Federal Reserve embarked on a series of interest rate hikes and set off a series of spiral reactions throughout the financial industry. According to experts, the repercussions of these actions are now being felt across the United States as banks begin to buckle under the pressure of the new economic landscape. The fallout has been nothing short of catastrophic, with customers attempting to withdraw a staggering $100 billion from the bank on the day it was shut down. But as officials began to sift through the wreckage, it emerged that the run on the bank was not limited to just a single day. Depositors had been steadily withdrawing their funds in the weeks leading up to the closure, with the largest outflow occurring on the day before the shutdown. In total, $42 billion was pulled from the bank on March 9th alone, leaving regulators scrambling to contain the fallout. Despite their efforts, it soon became clear that the situation was spiraling out of control. The queues of panicked depositors snaked around the block as officials struggled to process the never-ending stream of withdrawal requests. The scenes that played out in front of the bank were reminiscent of the Great Depression, as ordinary people fought tooth and nail to hold on to their hard-earned savings. So despite initial optimism that the rate hikes would be manageable, it is becoming increasingly clear that this was not the case. As the financial system groans under the weight of mounting losses, more and more experts are increasingly warning that the crisis is far from over. The past half-century has seen financial crises occur like clockwork once a decade, and many believe that the current situation is the latest in a long line of economic disasters. Over the past decade or so, banks have been operating in an unusual financial climate. Interest rates have been kept incredibly low, and central banks have been injecting cash into the economy from time to time. This was meant to be a temporary measure after the collapse of Lehman Brothers in 2008. However, the practice ended up becoming ingrained in the markets, and cheap and plentiful money became a constant prop for banks. Despite the potential risks, many governments and central banks continued to rely on low interest rates and other forms of stimulus to boost economic growth. However, these measures came with their own set of problems. For instance, in some countries, low interest rates led to housing bubbles, which ultimately burst and led to significant losses for banks. In the UK, the Bank of England was among the first to recognize the risk of prolonged low interest rates. So in December 2021, it began raising rates, and it has now done so 10 times in a row. Other central banks, such as the European Central Bank and the Federal Reserve, have been slower to act. In July of last year, the ECB finally decided to increase borrowing costs for the first time in a decade. And despite news that Credit Suisse was experiencing banking malaise, the ECB still went ahead with another rate hike just last month. Rate hikes have also since become the order of the day in the United States. The effects of these rate hikes have been significant. Housing bubbles have deflated and share prices have plunged. Banks have been left nursing big losses on their holdings of government bonds. And despite the relatively strong performance of the US, UK, and Eurozone economies following Russia's invasion of Ukraine, there are still concerns about an impending recession in the US. While changes in monetary policy can take time to have an impact, there are already several signs pointing toward an economic downturn. One major indicator is the housing market, which has already experienced a 20% downturn in the past year. This has significant implications for the broader economy, as the housing market often serves as a bellwether for overall economic health. Additionally, there continue to be growing concerns about the stability of regional banks in the U.S. This is coming after the ongoing issues at SVB and other institutions, suggesting that the second condition for a recession, bank failures, may be starting to emerge. Finally, there is the issue of rising unemployment. While the current unemployment rate has only risen by 0.2 percentage points, this could quickly escalate if a recession takes hold. Looking back at past recessions, there's a clear pattern of banks failing just before the onset of a recession. In the lead up to the recession that began in 2007, for example, no U.S. bank failed in 2005 or 2006. But the first 3 failures occurred in early 2007. Similarly, the first bank failures in the current cycle have just occurred, which is a worrying sign for the broader economy. And while it's often difficult to predict the timing and severity of a recession, these indicators are fast suggesting that a downturn could be more imminent than many Americans are prepared for. As the U.S. economy continues to deteriorate, policymakers have now found themselves facing a delicate balancing act. On the one hand, they're aware that even a cut in interest rates would not be sufficient to prevent output from declining in the coming months. On the other hand, tightening policy further in the face of falling inflation, plummeting global commodity prices, and mounting financial distress would be ill-advised. In addition, policymakers are acutely aware of the historical context of banking crises. The period after World War II was marked by tighter banking regulations, which meant that banks played a more peripheral role in the economy. However, over the past 50 years, the financial sector had undergone significant liberalization and grown substantially, making regulation and supervision more complex. This has been clearly shown in the case of SVB, which was supposed to be a small bank that was subject to less stringent regulations due to its non-systemic importance. However, when the banks encountered financial difficulties and was on the verge of collapse, all depositors were protected, blurring the lines between systemic and non-systemic banks. In essence, America's financial system remains inherently fragile and is not too big to fail as it's widely presumed. As it stands, policymakers are now left with a complex and challenging environment as they seek to prevent a catastrophic financial crisis. So while the 1950s and 60s were marked by strict regulations on the banking industry, which ensured the stability of the financial sector, it's unlikely that we will return to such a state of regulation due to the immense power that the banking industry now wields. The banking sector has become an integral part of a political decision-making process, which makes it challenging to implement tighter controls on banks. And despite the desirability of implementing tighter controls on banks, politicians are reluctant to do so due to the backlash that might result from the powerful banking industry. But the consequences of this lack of regulation are becoming increasingly apparent and are essentially what would continue to fuel the crisis at hand. One major issue is that economies like that of the U.S., which are heavily dependent on the financial sector, will continue to benefit only wealthy individuals, essentially owners of shares and properties. The rest of the population, especially Americans from low-income backgrounds, may not receive the same benefits, and the current stimulus is being withdrawn. And the likelihood of this crisis becoming full-blown in the system is now higher than ever, making it more challenging to avoid what's already being touted as being the next major financial crash. As the House Financial Services Committee gears up for more hearings, the anticipation among lawmakers is palpable. The committee's line of questioning will be thorough and probing, leaving no stone unturned as they delve deep into the inner workings of the finance industry. But this is just a beginning. With so many potential changes to financial regulations and supervision on the table, lawmakers are preparing for a long and arduous process of debate and deliberation. They know that the decisions they make could have far-reaching consequences for the industry, and they're determined to get it right. As the hearings progress, the eyes of the nation will be on the House Financial Services Committee, watching and waiting to see what decisions they make and how they will impact the future of the finance industry.